Never has our society consumed so many raw materials as here at the beginning of the 20th century. The emergence of new economic powers like China and India has set off an explosion in demand. This scramble for commodities has sent prices through the roof to the point where, in 2008, hunger riots broke out in developing countries. But China's insatiable appetite is not enough to explain the soaring prices. Clearly, some of the responsibility must fall on the markets themselves.
We can't afford a situation where speculators artificially manipulate markets by buying up oil, creating the perception of a shortage, and driving prices higher.
But these speculators Barack Obama's talking about, who exactly are they? How do these famously complex and opaque commodities markets actually work? To answer these two questions, you have to speak to the leading players in these markets, the commodities traders, who buy and ship the merchandise, then resell it. They're all members of an old corporation, the world of big business. The very first rule of this corporation is secrecy, and secrecy tends to feed people's imagination.
A trader is a company or an individual who buys merchandise in order to sell it on at a higher price.
It's a job where you hate risk, but our work's entirely based on taking those risks. We're not there to rob people. We're there to take risks, and if we get it right, make money.
We are merchants. We are market makers.
The commodities traders have made Geneva the hub of their activities. It has the banks and the tax breaks, so no less than 400 trading companies have based themselves there, among them some of the giants of the sector. Vitol is the world's leading oil trader, with a turnover of $300 billion. And then there's the club of 4 big agribusiness companies, who between them can lay claim to 80% of the world's grain market. They call them ABCD. Tucked away in the discreet canton of Zug, the Glencore Group is as powerful as it is secretive. With a turnover of over $250 billion, it's a player on all the commodities markets. But how much do we really know about these business giants? Almost nothing. Here on the shores of Lake Léman, the commodities traders cultivate anonymity and are notoriously camera-shy. The multinationals stick to their basic rule and won't talk to us. In a year-long exchange of emails, the Glencore Group will demonstrate its perfect mastery of the art of never saying no. The only company that will, through the voice of its managing director, explain its choice to remain silent is Louis Dreyfus Commodities.
In the past, we have too often noticed a tendency on the part of certain people to reduce the debate to a conflict between rich and poor, multinationals and small local farmers, technology and purity, etc. I hope you'll be contributing to enriching the debate to take it beyond the usual moralizing themes, as helpful as they may be. Best regards.
Meanwhile, though, other businessmen accepted to meet with us, such as Gilles Chotard, until recently an oil trader for one of the world's biggest oil trading companies.
Show me a top university graduate, a mining engineer, mathematics, philosophy graduate, and I'll show you one of the world's worst oil traders. A trader will tell you, well, this is the playing field, just go for it. Let your experience, your intelligence, and your nose for risk be your guide. And sometimes we screw up, good and proper. To give you an idea, on a $100 million cargo, you're trying to make 100 million. And if things are really volatile and you make a mistake, you're going to lose $3 million. So you're risking $3 million to make 100 million. And that's a really tough business, and only the best survive.
According to the traders, Mark Rich was the best. It was he who, back in the 70s, revolutionized the oil business. A mythic figure in whom all the ambiguities of the profession were incarnated.
Yes, I worked in his company. He was an extraordinary guy. He could speak 5 languages. He could absorb information and remember people and facts in the most extraordinary way. He had an instinct for risk and a talent for networking. He was our guru, really.
Everyone who met him will tell you Mark Rich was a great businessman. But on the human level, well, that was another story.
To this day, the name Mark Rich is associated with a scandal that took place in the 70s. In 1978, the mullahs seizing power in Iran led first to Iranian crude oil supplies being cut off and then to an American embargo. Both economically and politically, it was devastating.
Mark Rich made his fortune in the 70s by setting up trade between the Shah's Iran and Israel. But then he held on to his positions in the Ayatollah's Iran and kept trading in Iranian oil right through the Tehran hostage crisis at the American embassy.
Mark Rich now found himself on the FBI's 10 most wanted list and had to seek asylum in Switzerland. Until the day he died in the summer of 2013, he would never again set foot in the United States.
Clinton even gave Mark Rich an official pardon, but he never came back to the United States. I'd say Mark Rich always lived on the edge.
Ethically?
Ethically, well, no, he had no ethics. And he was even on the edge of what was legal and what wasn't.
Just how far can you go in business? Between Mark Rich and Glencore lies a very shadowy commercial zone. But let's get back to basics. Traders are first and foremost merchants, and they've been around for centuries. When the Amsterdam Stock Exchange first opened its doors in 1611 in a public square, business was booming. Prices, quantities, quality, delivery dates, all the arts of negotiation were in play. "400 years later, the rituals are still in place. In London, for example, where in the tradition of a glorious past, metal prices are called out each day at auction. It's a coded world for the initiates. As ever, if you want to trade, you still have to know your product. On the dockside at Le Havre, the cargoes of coffee keep coming in. It's the most widely traded commodity in the world. In this historic square, rich with the history of coffee trading, there are still some big traders, like Patrick Masson, 30 years on the job. He took over and saved the Jobin Company, founded in 1871. These days, he works for the world leader, the German Neumann Kaffee Group. It takes him 10 minutes by bike to get to the office and to the worldwide coffee market.
Washed Bahia at $2.99. That's pretty much the best in Brazil right now. I can send you a sample. I think I've got some in. The Morago, absolutely. Liquid Ambar MS. It's not rubbish. It's the real McCoy. Not Mickey Mouse. What we do is buy coffee and sell it according to customer demand. Our two main risk areas are first geographic, which means you have to know your suppliers who are selling the coffee at source. Then there's the price risk, because prices can vary greatly. That means if you've already been selling coffee to someone at, let's say, 100, and the market's gone up to 300, well, you have to honor your agreement. And that's the security we offer our clients. Little bit old. Don't know what it is, but it's a bit old. They want to sell us these coffees, but there's no way we're going to buy them, because they're no good. It's just not the quality we should expect from these coffees. It's really not what we're used to. Well, that's really bitter. No good, it's rancid. What we're really all about is the product. We know about coffee. We know how to promote it and how to describe it. We do our best to advise our customers on quality, on blends, etc. It's the product that counts.
London, along with New York, is one of the two main centers of the coffee trade. That's why there are so many traders in the British capital. Tarek Al-Qasinda used to work for one of the biggest coffee trading companies until he launched his own business. He's passionate about the product and about the market as well.
It's fantastic. You have the markets move. It's really interesting. It's one of the most volatile commodities in the world. It's fascinating. One year you have a huge crop, the next year you have a very small crop, compensated by a massive crop in that country or a smaller crop in that country. And all these numbers just are really interesting to play with. I travel quite a bit. I travel once a month at least to a producing country. See my clients, talk to them, try to do some business, see how it's going, look at the crops, how they're developing. You know, I've been doing it for the past 25 years, so.
Above all, commodities traders are globetrotters. Business isn't just done over the phone or by computer. Armand Ezerzer is on a business trip to Taiwan. He started out in sugar and dabbled in cocoa until he settled on cotton and founded his company Mambo Commodities. He's off to meet the big cotton spinners in the south of the island to sell them cotton. He's accompanied by Apollo Chang, his local agent, and Massaoud Mama, his associate in Togo.
Cotton traders are forever looking at cotton. It's hard to imagine doing this without touching it, seeing it. What prevents you seeing it as often as you'd like is all the office work involved. But you're still ticking all the boxes in your head. This cotton is like this, it comes from there. We're always being sent samples and checking them out in the sorting room. And that's how we keep the spinners satisfied and supply them with the cotton they want from year to year.
Spinning is the starting point in the worldwide textile industry. The cotton is transformed into spools of thread to supply the clothing factories in Cambodia, Laos, Bangladesh, and Ethiopia. The Yihua Company is one of the biggest spinners in Taiwan. Thousands of tons of cotton are bought every year by Mr. Tsai, who only does business with the biggest traders and is famously tough to deal with.
Yes, we are handling Greek cotton, yes.
Today, somebody called me 79.5 for the 1 inch and 1 inch. Yeah.
It depends for 41 or 31.
You mean 41, 31? 31. Middling.
Middling,
Yeah, middling.
it will be difficult for me to provide at this time of the year. I'm not the only one not looking for it. And there is a big premium to pay to have it. We have some strict laws. And even on strict law, this is really the best you can find.
Yeah.
We ship it immediately.
Yeah,
We have it in...
understood. You arrive at Taiwan. in
Yes,
December.
yes. But we have to agree on the quality. If you want, you have the samples here. We agree, we send you some sealed sample, and it will be exactly what you are going to receive, without fail.
I made him a firm offer. He just has to snap his fingers and it's confirmed. There's nothing on paper, but it's a firm offer. That's how it is. No need to have it on paper. And it's very misleading, because it can all seem to happen so casually. And then the deal's done, just like that. In a couple of seconds, the deal will be made, and there'll be millions of dollars in it. Because 82, that's 82 cents per pound of English cotton, which makes about $1,800 a ton. $1,800 times 500 tons, so we're already at $1 million just for what we were talking about this morning, for a few minutes. So there's no room for mistakes about the terms or about what you're promising, because if you get the terms wrong, there's no going back on them. It's just like in the school playground. What's said is said.
Millions of dollars just on somebody's word. That's how they do business in the cotton trade. But selling's only part of the job. You have to know when to buy. Being a trader means, above all, being prepared. To be prepared, commodities traders have to analyze and interpret information from all over the world. Jack Kane is a rice trader. He works from Geneva, where he runs the Novell Commodities Company.
Some of the major groups have research departments that keep a constant eye on supply and demand, so they can anticipate the relationship between the two in the short, medium, and long term. I think that's how decisions are reached. Then the results will turn out to be either right or wrong. And depending on the positions that are taken, they'll determine the profit or the loss made on the transactions.
And that's what's known as feeling the market?
Yes, it certainly isn't an exact science, but that is indeed what we call feeling the market.
Paul Perk is a Dutchman living in Brazil. He's an old hand at international agricultural commodities trading, and he's learned to check his sources.
Information's the key. Because if one of your colleagues gives you some wrong information from China, say, telling you, for example, that China has enough corn this year to feed all its pigs and chickens, because he's been out to look at the harvests and he reckons everything's okay, but then it turns out it's not okay at all, and China suddenly turns up on the market and imports 10 million tons, then that's for sure going to completely change the prices.
And what happens if you haven't seen it coming?
You lose a lot of money in general.
Agricultural commodities such as wheat represent a considerable gamble. The traders follow the harvest very carefully and can quickly check out whether their information is accurate. To be ahead of the game, though, you need the right contacts and a good network. In 2010, Russia suffered a terrible drought, and the wheat harvest was looking like a disaster. To prioritize the needs of the Russian population, the Kremlin decided to stop all exports. Within 2 days, the international market price of the grain had risen by 15%. The Glencore Group found all its connections revealed on the front pages of the financial press.
Right from the start, it's really been a very controversial firm, and it's often been in the news, notably in 2010, when it admitted speculating upward the price of corn and wheat. And this at the time Russia was having a drought that year. And at the same time, they publicly demanded that Russia ban all grain exports. Russia didn't waste any time complying. So within a few days, world food prices took a brutal rise of 30%. And that way, Glencore made a considerable profit.
If Glencore heard on the grapevine from its links with certain oligarchs who were close to Putin, if they knew for sure there'd be an embargo, well, that's when you take positions. It's information. It's pretty close to insider trading, but it's a worldwide market where insider trading does happen. Well, nobody's a saint. And in quite a few countries, let's not kid ourselves, it does go on. Things are corrupt. And there are some trading companies that are more or less ethical, and others, some of whom you've mentioned, who have no idea of ethical behavior.
But there's a lot more to trading than this. A trader takes a chance when he buys raw materials even before they're produced. A year before the harvest, the cotton has already been negotiated. Armand Desessert has for a long time been working with Burkina Faso, today one of Africa's foremost producers of cotton. The harvest season is starting, and the producers are bringing in the crop.
We'll see it better at the factory. They'll clean off all these bits here.
We'll see.
Armand Desessert's business contact is Sofitex, a semi-public company that oversees and commercializes cotton production in the west of the country of 500,000 tons of cottonseed. Armand Desessert has already bought this cotton a year before it's been harvested. He's not only bought it, but has already sold it to Asian spinners.
I hope it'll be better than last year.
Donc ça, c'est une usine de Solinzo.
Will the promised quality be delivered? It's the moment of truth.
On vient
We come here to the sorting room to see Joël and we say, right, so what are we really getting here? We have to deliver to our clients and we have to know what we'll be giving them. And you have to match the specifications of what you're selling as closely as possible to what's being delivered. And you'd never be able to do that without the results you get from the sorting room.
79 la fin.
Je prends Bobby à 98. 98 Bobby, 601 Bobby et 532.
The moment the cotton is baled up, the traders try to move the merchandise as fast as they can to respect their deadlines. It's all now a question of logistics, and everyone's in the same boat. Be it Louis Dreyfus, Cargill, or Armand Desessert. They all sit there in the same chair, opposite Paul Sourabier, who controls all shipments for Sofitex. He's the man you have to negotiate with.
I can start loading, but I don't know when they'll be leaving.
Can you get it off by train then?
Yes, by train, no problem. I already started doing that last week.
If all goes well, these balls of Burkina Faso cotton will in a few months be in the hands of the Asian spinners. From purchase of the product until delivery, the commodities traders need a lot of financing. That's where the banks come in.
A bank really hates risk. A trader likes a bit of a risk, but it's something a banker just can't stand. So he lets the oil trader take the risk while the bank finances it in the background.
Oil trading, for instance, has certain merits, such as that you typically transact large tickets, which makes it operationally very efficient. If you look at a crude oil trader which executes transactions with a typical tenor of 45 days, that means that they can turn around 8 times their credit line a year. And knowing that crude oil cargo is something between $120 to $250 million, you can imagine what amount of money is involved in that business. And
no, I don't imagine.
You know.
But can you tell us?
I mean, there are, in the crude oil sector, there are companies which have turnovers between 100 million upwards to $200–300 million, the very big ones. $1 billion, yes.
Well, I don't use a lot of bankers today. I use trade finance funds because the banks have been very erratic in their relationships. When it's sunny, they give an umbrella. When it's raining, they take it away. And they tend to do that all the time.
But that means that you don't like risk, you are risk adverse, but banks too.
Banks too, but sometimes, you know, back in 2008 and 2009, the shares collapsed and they didn't have enough cash to provide financing. And it was a drama. It was horrifying. We were wondering how the world is functioning, how the trade flows are being financed. The banks cut a lot of lines to a lot of people.
Did they cut for you?
At the time, yes. Yes.
So what happened?
At the time, I had to liquidate my company, yes. Yes.
Was it a drama?
Worse than a drama, yes. Yes. It was my life, yes.
Traders who love their product and their job have also for a long time had the reputation of being speculators. The history of trading is also the history of speculating. As far back as 1909, in his film A Corner in Wheat, the American filmmaker D.W. Griffith tells of unscrupulous dealings of a speculator as he makes his fortune on the back of the suffering peasants.
Speculating is part of the job. It's important for a trader, and in my case, the commodity I'm dealing in is rice, to be able to foresee the rise and fall in prices. So you have to take a position and buy what you know you can sell at a profit, or sell only when you're going to make a profit, and that means speculating.
They call Anthony Ward Chocolate Finger. He's considered to be the world's greatest trader in cocoa. In 2010, he hit the headlines when he bought almost all the cocoa stocks on the Ivory Coast, the world's biggest exporter. Just weeks later, civil war broke out in Abidjan, and cocoa prices went through the roof. Anthony Ward had played a winning hand. The wheel turns, though, and in November 2013, he had to sell his business.
It's perfectly obvious that for the dominant players on the market, there's always the temptation to hold back sales in the hope that the price will rise, to buy up as much as they can to force prices up and then sell at a big profit. That's what trading's all about. The big problem, though, is the lack of transparency.
There may be a certain discretion about the business. Perhaps companies don't share information about their infrastructures, about how many silos or warehouses they've got. But there's no way there are any hidden stocks, any Alibaba's caves hidden away in deepest Amazonia. That just doesn't happen.
But an unprecedented revolution is set to shake up the world of trade and opening the door to an entirely different kind of speculation. You have to go to Chicago to understand what's happened at the turn of the 21st century. Both traders and producers have always sought to keep one step ahead of price fluctuations. To manage the risk, they created the futures markets. The most famous of them is the Chicago Board of Trade, a legendary center of the agricultural commodities market. There are other traders working here known as paper traders, as opposed to traders on the physical market. Tres Knipper is a paper trader.
I'm watching crude oil here. I've got a big position in crude. I'm also watching other markets. And then I'm on Twitter. And so I will monitor. Twitter, for me, is a good source of news because people will talk about what's going on and it'll show up. So I'll kind of keep an eye on that. And then I'll make comments. There's some people that are listening to my comments in the crude oil, and I'll kind of tweet about it and say, I think this or I think that. You know, just if anything else, it's to watch and see what's going on.
At the Chicago Board of Trade, paper traders like Tres Knipper deal in futures. In financial speak, a future is a derivative product. For the traders, it's a form of insurance that covers them against price fluctuations.
Actually, if the futures markets exist, it's because the insurance companies refuse to insure against price risk, and for one very simple technical reason. If you have a car, you can insure it against theft or against fire because you know how much it's worth. And the insurer, too, knows just how much a particular car is worth, so he'll insure it at a rate that he's able to estimate. He can fix the price and the amount. With raw materials, though, the margin for price rises or drops, especially rises, is infinite. So the risk isn't quantifiable. And it's because the insurance companies couldn't cover that risk that the futures markets were created.
When you buy a large quantity of cotton at any given moment, you know you're going to resell it in a month, or 6 months, or in a year or two. Throughout the length of this contract, as long as you haven't sold it, you're at risk from the price. So there's a way of ensuring this price risk, the financial market.
So to cover himself against price fluctuations, Armand Ezezer is going to sell a future to Tres Knipper.
I sold all the jeans at 120.80.
In stock market language, it's known as a position.
21023.
And when you're actually selling your physical product to the spinners, you buy that position back on the stock market, which sells it back to you.
Sold.
Tres Knipper is a speculator.
I'm working these at even. I apologize, we did nothing.
By buying and selling futures, he hopes to make a profit while enabling the traders to cover themselves against varying prices.
You good? All right.
It's the time-honored custom for the producers and the buyers of agricultural products to cover themselves against evolving prices and against the unpredictable risk that entails. The speculation this involves is basically healthy, and it encourages and facilitates fair exchange. But it's true that the arrival of big investment institutions, investment funds and investment banks, whose only motive in the way they approach the markets is a financial one, has twisted the rules of the game.
In the year 2000, the internet bubble had burst and IT stocks had collapsed, and investors turned to the commodities market for new sources of profit. The big banks and the pension funds like CalPERS, which alone handles $280 billion, started mass buying futures. Commodities prices soared.
These days, we just don't know what the big funds are up to. Why do they suddenly turn up on the market and invest billions in sugar, for example, or oil or soya? We can't know why they do it, because they have such wide portfolios that they have to invest a certain percentage in soya, a certain percentage in coffee or in sugar, in gold, in oil, or in currencies. And with all the money they've got, well, it all comes in at once, and the market just can't control it.
They say to the manager of CalPERS, "Look, mate, if you don't bring in a 12 or 14% return on investments, you're fired." And the CalPERS guy, he's going to raise the stakes. And of course, then the trader doesn't have a chance, because he's dealing in physical commodities, whereas the sheer volume of paper trading has become much more important.
Traders who are employed by investors have a know-how that's very adaptable. They're just as good on the stock market as on the metal or oil markets. And if you take a trader who's working in wheat, for example, and you move him over into oil, he'll be fine, because it's probably going to be the same tools he's using. And that's because he's not dealing with the fundamentals of the market. He's using mathematical tools.
The latest development in this new virtual world of trading is the creation of computer bots, programmed by algorithms and capable of taking both buying and selling positions at the least fluctuation of the market.
You sometimes get what we call automatic orders as a result of this kind of trading that just turn up on the market out of the blue with buying or selling orders for thousands of shares. And that obviously immediately causes quite a lot of frankly ill-considered movement. We usually hear about it the next day, when the experts from the commission agencies inform us that automatic orders have come through from some computer. That's how we find out. But you know, once you've seen the shares, it's too late. It's a done deal. They've either been sold or bought, so most of the time there's nothing you can do about it. You just have to live with it.
Irrational behavior is becoming a characteristic of the market. High-frequency bots work by the millisecond, and they can make colossal profits or, in the space of minutes, bring about huge crashes.
Yeah, or 02954.
Financiers all claim they have nothing to do with steep price rises. According to them, speculation merely amplifies the high prices, which in fact will always remain fundamentally linked to supply and demand of the physical product. In 2008, though, the crisis that hit the cotton market proved this claim to be untrue. That year, the harvest was good, and the prices increased only slightly. It was a windfall for the investment funds, who saw great potential profits in it. They bought up huge numbers of cotton contracts, and in the space of a few months, prices doubled.
The reaction from traders was first of all one of panic. It was real panic, because it was just like a great big hole. We were heading into a black hole, and we didn't know what to do. We were scrabbling for money every day. We couldn't sell anything, and we didn't know how long it'd go on. You were calling your banker every day saying, "I've got my futures position, my physical position, you have to cover me."
So how much was at stake?
Well, for a company like ours, it was several $100,000 every morning. That's pretty much untenable. And so the banks were saying, look, we can't go with that. Liquidate your position. For any traders who found themselves having to liquidate their position, that meant a net loss. I think there was before 2008 and after 2008 for a company like ours, and also for others that were a lot bigger. It meant thinking again about investing in the futures market. And it also meant rethinking what period of time we could leave ourselves at risk from prices.
There you have a flagrant example of serious distortion or deregulation, all the more so because it resulted in quite a few bankruptcies, with big cotton trading companies being forced to close down. A lot of traders just disappeared. This was all directly linked to a kind of speculation that is totally out of line with the reality of the world economy.
This speculative drift would in 2008 extend to other markets and affect basic foodstuffs. In countries already weakened by a lack of agricultural policies and by corruption, the food situation worsened. Riots broke out.
The heart of the problem was the perverse system by which, through the 80s and for 30 years now, countries have become more and more dependent on imports to feed themselves. And when a state owes its political stability to rice or bread prices that are relatively affordable for the whole population and has to import all its rice or wheat, which is the case for many West African countries, for example, you can understand governments being a little jumpy about these situations.
In 2011, on the New York stock market, oil prices reached new heights that threatened the fragile economic recovery. Barack Obama put his foot down and named the guilty parties.
We can't afford a situation where speculators artificially manipulate markets by buying up oil, creating the perception of a shortage, and driving prices higher, only to flip the oil for a quick profit. We can't afford a situation where some speculators can reap millions while millions of American families get the short end of the stick.
It's a cliche to say that we make oil more expensive. It's completely untrue. We just try to buy it as cheap as possible and get the best price we can for it. We try to optimize the income, if you like. We don't care if the absolute price is $100 a barrel, or $25 a barrel, or $80 a barrel. What matters to us is the volatility, the movement of prices.
So even as we're
what bothers Mr. Obama is that he has no control. He's faced with 5 or 6 trading companies based in Switzerland that are totally private and who do business with whomever they want.
Transfer to Metra and South Shore trains at Randolph and Wabash. This is an Orange Line train to Midway.
The CFTC, the American Market Authority, has regulatory measures for speculation, intended to limit the interventions of pure financiers. At the Chicago Board of Trade, regulatory measures are never very welcome.
For me, 2008 was a really, really good year. It all depends on your position. And so there's not a good market or a bad market. It's how are you responding to the market itself, not necessarily good or bad. All that stuff is just a smokescreen. All that stuff is oh, there's an evil market force out there that's hurting customers. That's nonsense. Open the free market, let free markets trade, have the government and the regulators stay out of it, and then if somebody wants to not participate in the market, if they think the market is somehow unfair to them, then by all means, find another market that they do think is fair. But you start dictating, who can and can't trade? No way. Free markets for free men. No thanks.
The prices that traders on the physical markets use and refer to are fixed on the financial markets. So these financial bubbles that blow up and then burst have a direct influence out in the field on the traders for the net importer countries of foodstuffs, and even on the producers of these products. And unfortunately, there's a sort of smokescreen over the fact that the financial markets affect the prices of agricultural raw materials. And I think that's a big problem.
Basically, what were the markets telling us? The markets were saying, listen, kids, there are 7 billion of you. In a few years, it'll be 10 billion. And still, you're not investing in agriculture. Well, perhaps it's time to wake up. That's the message from the markets.
Producers who follow the market carefully try to make a profit out of rising prices. But the smaller of them are often helpless, faced with the extreme volatility of prices.
Producers have great trouble aligning themselves to price signals. They find it difficult to change crop, too. In the United States, it's easy enough to switch from growing soya to growing corn, for example, whose price is rising because of the demand for ethanol. But for a lot of growers in the developing countries, the crops they grow depend on soil gradients, precipitation, their own experience, the availability of seed. They can't change crop just like that. The price rises will benefit the intermediaries, the traders and stockbrokers, but not the small producers at the beginning of the chain.
The big producers do well out of the explosion in demand and the rising prices. In Brazil, soya, which is essential for feeding all livestock, represents today a huge market. In 10 years, its production has almost tripled. The farmers have become real businessmen. In the Rio Grande do Sul, in the south of the country, Pedro Luis Herter runs a medium-sized farm of over 10,000 acres. He may continue to work with the traders, but these days he has ways to cut them out.
That's right. We're in great demand by Chinese companies to directly export soya. But the distances involved make it quite complicated to guarantee both delivery and the quality of the merchandise on arrival. It's true that when it comes to that, the traders are really good for our peace of mind. I think the big companies could now deal directly with the Chinese, but not the small or medium-sized businesses. They won't have the means. It'll just be too expensive for them. In fact, what the Chinese want is to get away from the Chicago stock market prices. What they usually do is ask me to fix a price that's lower than the stock market price. So that limits our possibilities. What we're doing now is exporting directly per container. This is new for us, so we'll see how it goes.
This direct dealing between producer and importer is still suffering from numerous logistical problems. At the moment, the Brazilian port of Santos, where the soya is loaded, is overstretched. But this kind of initiative looks like the economic model of the future. The big producers are intending to become traders themselves, and the traders producers. A market trend that may well even further sideline the small farmers.
I rather believe that what we will be facing in the future is that producing companies, upstream companies, will create their own trading outfit in countries like Switzerland. And in fact, this is exactly what has happened and what will continue to happen.
I think it's a poor man's business today to be a medium-sized trade house or a small trade house. It's very difficult. You have to have very niche markets. We do the unwanted business that the big boys don't want to do.
The future belongs to the big conglomerates that represent the whole sector. In Geneva, ABCD have become producers, industrialists, and financiers.
Cargill, for example, was the first of the four to set up an investment fund called Black River Asset Management, whose job is to speculate on the financial commodities market, both for the parent company and others. So these companies are also selling financial services and speculating directly on the agricultural commodities financial markets.
ABCD are very good at both jobs, and their directors keep all communication to a minimum.
They don't want people to know about them. They have no interest in that. All it would bring them would be criticism. Why court publicity?
I don't imagine for a minute that people would like to hear that, let's say, A, B, C, or D are making something like $5 billion a year trading in bread or cooking oil or chicken or beef.
These trading giants may look right now like masters of the universe. But the history of trading is littered with seemingly invincible empires like theirs that, through their own arrogance, have been swept away by an indifferent market. Even so, one thing won't change. It's the traders who keep on making the world go round.
It's really not the issue as far as treasury is concerned. Well, it's a good cotton. I mean, the color, it's very similar to the American cotton.
And the color is the little correct.
You don't like it?
你可以中来。
可以哈，来考虑那个巴西人怎么样？
He said he preferred to buy the Brazil. If they compare.
Yes, but the prices are very high.
How much?
For regular type, it would be around 84, 85 cents, which is very high.
Because he said he can buy from the competitor.
And how many tons is he looking for?
300 tons.
Tell him that in the meantime I'm gonna look for high grades from Brazil for him if he wants.
So tonight you have the better price. He may be considered to buy tomorrow.
Okay.
Problems. At the moment, the Brazilian port of Santos, where the soya is loaded, is overstretched. But this kind of initiative looks like the economic model of the future. The big producers are intending to become traders themselves, and the traders producers. A market trend that may well even further sideline the small farmers.
I rather believe that what we will be facing in the future is that producing companies, upstream companies, will create their own trading outfit in countries like Switzerland. And in fact, this is exactly what has happened and what will continue to happen.
I think it's a poor man's business today to be a medium-sized trade house or a small trade house. It's very difficult. You have to have very niche markets. We do the unwanted business that the big boys don't want to do.
The future belongs to the big conglomerates that represent the whole sector. In Geneva, ABCD have become producers, industrialists, and financiers.
Par exemple, Cargill, for example, was the first of the four to set up an investment fund called Black River Asset Management, whose job is to speculate on the financial commodities market, both for the parent company and others. So these companies are also selling financial services and speculating directly on the agricultural commodities financial markets.
ABCD are very good at both jobs, And their directors keep all communication to a minimum.
They don't want people to know about them. They have no interest in that. All it would bring them would be criticism. Why court publicity?
I don't imagine for a minute that people would like to hear that, let's say, A, B, C, or D are making something like $5 billion a year trading in bread or cooking oil or chicken or beef.
These trading giants may look right now like masters of the universe. But the history of trading is littered with seemingly invincible empires like theirs that, through their own arrogance, have been swept away by an indifferent market. Even so, one thing won't change. It's the traders who keep on making the world go round.
It's really not the issue as far as trade is concerned.
To answer these two questions, you have to speak to the leading players in these markets, the commodities traders, who buy and ship the merchandise, then resell it. They're all members of an old corporation, the world of big business. The very first rule of this corporation is secrecy, and secrecy tends to feed people's imagination.
A trader is a company or an individual who buys merchandise in order to sell it on at a higher price.
It's a job where you hate risk, but our work's entirely based on taking those risks. We're not there to rob people. We're there to take risks, and if we get it right, make money.
We are merchants. We are market makers.
The commodities traders have made Geneva the hub of their activities. It has the banks and the tax breaks, so no less than 400 trading companies have based themselves there, among them some of the giants of the sector. Vitol is the world's leading oil trader, with a turnover of $300 billion. And then there's the club of 4 big agribusiness companies, who between them can lay claim to 80% of the world's grain market. They call them ABCD. Tucked away in the discreet canton of Zug, the Glencore Group is as powerful as it is secretive. With a turnover of over $250 billion, it's a player on all the commodities markets. But how much do we really know about these business giants? Almost nothing. Here on the shores of Lake Léman, the commodities traders cultivate anonymity and are notoriously camera-shy. The multinationals stick to their basic rule and won't talk to us. In a year-long exchange of emails, the Glencore Group will demonstrate its perfect mastery of the art of never saying no. The only company that will, through the voice of its managing director, explain its choice to remain silent is Louis Dreyfus.
We were heading into a black hole, and we didn't know what to do. We were scrabbling for money every day. We couldn't sell anything, and we didn't know how long it'd go on. You were calling your banker every day saying, "I've got my futures position, my physical position, you have to cover me."
So how much was at stake?
Well, for a company like ours, it was several $100,000 every morning. That's pretty much untenable. And so the banks were saying, "Look, we can't go with that. Liquidate your position." For any traders who found themselves having to liquidate their position, that meant a net loss.
I think there was before 2008 and after 2008 for a company like ours, and also for others that were a lot bigger. It meant thinking again about investing in the futures market. And it also meant rethinking what period of time we could leave ourselves at risk from prices.
There you have a flagrant example of serious distortion or deregulation, all the more so because it resulted in quite a few bankruptcies, with big cotton trading companies being forced to close down. A lot of traders just disappeared. This was all directly linked to a kind of speculation that is totally out of line with the reality of the world economy.
This speculative drift would in 2008 extend to other markets and affect basic foodstuffs. In countries already weakened by a lack of agricultural policies and by corruption, the food situation worsened. Riots broke out.
The heart of the problem was the perverse system by which, through the 80s and for 30 years now, countries have become more and more dependent on imports to feed themselves. And when a state owes its political stability to rice or bread prices that are relatively affordable for the whole population and has to import all its rice or wheat, which is the case for many West African countries, for example, you can understand governments being a little jumpy about these situations.
In 2011, on the New York stock market, oil prices reached new heights that threatened the fragile economic recovery. Barack Obama put his foot down and named the guilty parties.
We can't afford a situation where speculators artificially manipulate markets by buying up oil, creating the perception of a shortage, and driving prices higher, only to flip the oil for a quick profit. We can't afford a situation where some speculators can reap millions while millions of American families get the short end of the stick.
It will be difficult for me to provide at this time of the year. I'm not the only one not looking for it. And there is a big premium to pay to have it. We have some strict laws. And even on strict law, this is really the best you can find.
Yeah.
We ship it immediately.
Yeah,
we have it in...
You arrive at Taiwan.
Yes. But we have to agree on the quality. If you want, you have the samples here. We agree, we send you some sealed sample, and it will be exactly what you are going to receive, without fail.
I made him a firm offer. He just has to snap his fingers and it's confirmed. There's nothing on paper, but it's a firm offer. That's how it is. No need to have it on paper. And it's very misleading, because it can all seem to happen so casually. And then the deal's done, just like that. In a couple of seconds, the deal will be made, and there'll be millions of dollars in it. Because 82, that's 82 cents per pound of English cotton, which makes about $1,800 a ton. $1,800 times 500 tons, so we're already at $1 million just for what we were talking about this morning, for a few minutes. So there's no room for mistakes about the terms or about what you're promising, because if you get the terms wrong, there's no going back on them. It's just like in the school playground. What's said is said.
Millions of dollars just on somebody's word. That's how they do business in the cotton trade. But selling's only part of the job. You have to know when to buy. Being a trader means, above all, being prepared. To be prepared, commodities traders have to analyze and interpret information from all over the world. Jack Kane is a rice trader. He works from Geneva, where he runs the Novell Commodities Company.
Some of the major groups have research departments that keep a constant eye on supply and demand, so they can anticipate the relationship between the two in the short, medium, and long term.
Some sealed sample, and it will be exactly what you are going to receive, without fail.
I made him a firm offer. He just has to snap his fingers and it's confirmed. There's nothing on paper, but it's a firm offer. That's how it is. No need to have it on paper. And it's very misleading, because it can all seem to happen so casually. And then the deal's done, just like that. In a couple of seconds, the deal will be made, and there'll be millions of dollars in it. Because 82, that's 82 cents per pound of English cotton, which makes about $1,800 a ton. $1,800 times 500 tons, so we're already at $1 million just for what we were talking about this morning, for a few minutes. So there's no room for mistakes about the terms or about what you're promising, because if you get the terms wrong, there's no going back on them. It's just like in the school playground. What's said is said.
Millions of dollars just on somebody's word. That's how they do business in the cotton trade. But selling's only part of the job. You have to know when to buy. Being a trader means, above all, being prepared. To be prepared, commodities traders have to analyze and interpret information from all over the world. Jack Kane is a rice trader. He works from Geneva, where he runs the Novell Commodities Company.
Some of the major groups have research departments that keep a constant eye on supply and demand, so they can anticipate the relationship between the two in the short, medium, and long term. I think that's how decisions are reached. Then the results will turn out to be either right or wrong. And depending on the positions that are taken, they'll determine the profit or the loss made on the transactions.
And that's what's known as feeling the market?
Yes, it certainly isn't an exact science, but that is indeed what we call feeling the market.
Finance is it in the background.
Oil trading, for instance, has certain merits, such as that you typically transact large tickets, which makes it operationally very efficient. If you look at a crude oil trader which executes transactions with a typical tenor of 45 days, that means that they can turn around 8 times their credit line a year. And knowing that crude oil cargo is something between $120 to $250 million, you can imagine what amount of money is involved in that business. And
no, I don't imagine.
You know.
But can you tell us?
I mean, there are, in the crude oil sector, there are companies which have turnovers between 100 million upwards to $200–300 million, the very big ones. $1 billion, yes.
Well, I don't use a lot of bankers today. I use trade finance funds because the banks have been very erratic in their relationships. When it's sunny, they give an umbrella. When it's raining, they take it away, and they tend to do that all the time.
But that means that you don't like risk. You are risk adverse, but banks too.
Banks too, but sometimes, you know, back in the in 2008 and 2009, their shares collapsed and they didn't have enough cash to provide financing. And it was a drama. It was horrifying. We were wondering how the world is functioning, how the trade flows are being financed. The banks cut a lot of lines to a lot of people.
Did they cut for you?
At the time, yes. Yes.
So what happened?
At the time, I had to liquidate my company, yes. Yes.
Was it a drama?
Worse than a drama, yes. Yes. It was my life, yes.
Traders who love their product and their job have also for a long time had the reputation of being speculators. The history of trading is also the history of speculating. As far back as 1909, in his film A Corner in Wheat, the American filmmaker D.W. Griffith tells of unscrupulous dealings of a speculator as he makes his fortune on the back of the suffering peasants.
Speculating is part of the job.
Jack Kane is a rice trader. He works from Geneva, where he runs the Novell Commodities Company.
Some of the major groups have research departments that keep a constant eye on supply and demand, so they can anticipate the relationship between the two in the short, medium, and long term. I think that's how decisions are reached. Then the results will turn out to be either right or wrong. And depending on the positions that are taken, they'll determine the profit or the loss made on the transactions.
And that's what's known as feeling the market?
Yes, it certainly isn't an exact science, but that is indeed what we call feeling the market.
Paul Perk is a Dutchman living in Brazil. He's an old hand at international agricultural commodities trading, and he's learned to check his sources.
Information's the key. Because if one of your colleagues gives you some wrong information from China, say, telling you, for example, that China has enough corn this year to feed all its pigs and chickens, because he's been out to look at the harvests and he reckons everything's okay, but then it turns out it's not okay at all, and China suddenly turns up on the market and imports 10 million tons, then that's for sure going to completely change the prices.
And what happens if you haven't seen it coming?
You lose a lot of money in general.
Agricultural commodities such as wheat represent a considerable gamble. The traders follow the harvest very carefully and can quickly check out whether their information is accurate. To be ahead of the game, though, you need the right contacts and a good network. In 2010, Russia suffered a terrible drought, and the wheat harvest was looking like a disaster. To prioritize the needs of the Russian population, the Kremlin decided to stop all exports. Within 2 days, the international market price of the grain had risen by 15%. The Glencore Group found all its connections revealed on the front pages of the financial press.
Right from the start, it's really been a very controversial firm, and it's often been in the news, notably...
I made him a firm offer. He just has to snap his fingers and it's confirmed. There's nothing on paper, but it's a firm offer. That's how it is. No need to have it on paper. And it's very misleading, because it can all seem to happen so casually. And then the deal's done, just like that. In a couple of seconds, the deal will be made, and there'll be millions of dollars in it. Because 82, that's 82 cents per pound of English cotton, which makes about $1,800 a ton. $1,800 times 500 tons, so we're already at $1 million just for what we were talking about this morning, for a few minutes. So there's no room for mistakes about the terms or about what you're promising, because if you get the terms wrong, there's no going back on them. It's just like in the school playground. What's said is said.
Millions of dollars just on somebody's word. That's how they do business in the cotton trade. But selling's only part of the job. You have to know when to buy. Being a trader means, above all, being prepared. To be prepared, commodities traders have to analyze and interpret information from all over the world. Jack Kane is a rice trader. He works from Geneva, where he runs the Novell Commodities Company.
Some of the major groups have research departments that keep a constant eye on supply and demand, so they can anticipate the relationship between the two in the short, medium, and long term. I think that's how decisions are reached. Then the results will turn out to be either right or wrong. And depending on the positions that are taken, they'll determine the profit or the loss made on the transactions.
And that's what's known as feeling the market?
Yes, it certainly isn't an exact science, but that is indeed what we call feeling the market.
Paul Perk is a Dutchman living in Brazil. He's an old hand at international agricultural commodities trading, and he's learned
why we're going to buy them. Because they're no good. It's just not the quality we should expect from these coffees. It's really not what we're used to. Well, that's really bitter. No good, it's rancid. What we're really all about is the product. We know about coffee. We know how to promote it and how to describe it. We do our best to advise our customers on quality, on blends, etc. It's the product that counts.
London, along with New York, is one of the two main centers of the coffee trade. That's why there are so many traders in the British capital. Tarek Al-Qasinda used to work for one of the biggest coffee trading companies until he launched his own business. He's passionate about the product and about the market as well.
It's fantastic. You have the markets move. It's really interesting. It's one of the most volatile commodities in the world. It's fascinating. One year you have a huge crop, the next year you have a very small crop, compensated by a massive crop in that country or a smaller crop in that country. And all these numbers just are really interesting to play with. I travel quite a bit. I travel once a month at least to a producing country. See my clients, talk to them, try to do some business, see how it's going, look at the crops, how they're developing. You know, I've been doing it for the past 25 years, so.
Above all, commodities traders are globetrotters. Business isn't just done over the phone or by computer. Armand Ezerzer is on a business trip to Taiwan. He started out in sugar and dabbled in cocoa until he settled on cotton and founded his company Mambo Commodities. He's off to meet the big cotton spinners in the south of the island to sell them cotton. He's accompanied by Apollo Chang, his local agent, and Masaoud Mama, his associate in Togo.
Cotton traders are forever looking at cotton. It's hard to imagine doing this without touching it, seeing it. What prevents you seeing it as often as you'd like is all the office work involved. But you're still ticking all the boxes in your head. This cotton is like this, it comes from there. We're always being sent samples and checking them out in the sorting room. And that's how we keep the spinners satisfied and supply them with the cotton they want from year to year. We come here to the sorting room to see Joël and we say, right, so what are we really getting here? We have to deliver to our clients and we have to know what we'll be giving them. And you have to match the specifications of what you're selling as closely as possible to what's being delivered. And you'd never be able to do that without the results you get from the sorting room.
79,900. Un bobby à 98. 98 bobby, 601 bobby et 532.
The moment the cotton is baled up, the traders try to move the merchandise as fast as they can to respect their deadlines. It's all now a question of logistics, and everyone's in the same boat. Be it Louis Dreyfus, Cargill, or Armand Ezezer. They all sit there in the same chair, opposite Paul Sourabier, who controls all shipments for Sofitex. He's the man you have to negotiate with.
I can start loading, but I don't know when they'll be leaving.
Can you get it off by train then?
Yes, by train, no problem. I already started doing that last week.
If all goes well, these balls of Burkina Faso cotton will in a few months be in the hands of the Asian spinners. From purchase of the product until delivery, the commodities traders need a lot of financing. That's where the banks come in.
A bank really hates risk. A trader likes a bit of a risk, but it's something a banker just can't stand. So he lets the oil trader take the risk while the bank finances it in the background.
Oil trading, for instance, has certain merits, such as that you typically transact large tickets, which makes it operationally very efficient. If you look at a crude oil trader which executes transactions with a typical tenor of 45 days, that means that they can turn around 8 times their credit line a year. And knowing that crude oil cargo is something between $120 to $250 million, you can imagine what amount of money is involved in that business. And
no, I don't imagine.
You know.
But can you tell us?
I mean, there are, in the crude oil sector, there are companies which have turned...
...has asked me to fix a price that's lower than the stock market price. So that limits our possibilities. What we're doing now is exporting directly per container. This is new for us, so we'll see how it goes.
This direct dealing between producer and importer is still suffering from numerous logistical problems. At the moment, the Brazilian port of Santos, where the soya is loaded, is overstretched. But this kind of initiative looks like the economic model of the future. The big producers are intending to become traders themselves, and the traders producers. A market trend that may well even further sideline the small farmers.
I rather believe that what we will be facing in the future is that producing companies, upstream companies, will create their own trading outfit in countries like Switzerland. And in fact, this is exactly what has happened and what will continue to happen.
I think it's a poor man's business today to be a medium-sized trade house or a small trade house. It's very difficult. You have to have very niche markets. We do the unwanted business that the big boys don't want to do.
The future belongs to the big conglomerates that represent the whole sector. In Geneva, ABCD have become producers, industrialists, and financiers.
Cargill, for example, was the first of the four to set up an investment fund called Black River Asset Management, whose job is to speculate on the financial commodities market, both for the parent company and others. So these companies are also selling financial services and speculating directly on the agricultural commodities financial markets.
ABCD are very good at both jobs, and their directors keep all communication to a minimum.
They don't want people to know about them. They have no interest in that. All it would bring them would be criticism. Why court publicity?
I don't imagine for a minute that people would like to hear that, let's say, A, B, C, or D are making something like $5 billion a year trading in bread or cooking oil or chicken or beef.
These trading giants may look right now like masters of the universe. But the history of trading is littered with seemingly invincible.
A lot of traders just disappeared. This was all directly linked to a kind of speculation that is totally out of line with the reality of the world economy.
This speculative drift would in 2008 extend to other markets and affect basic foodstuffs. In countries already weakened by a lack of agricultural policies and by corruption, the food situation worsened. Riots broke out.
The heart of the problem was the perverse system by which, through the 80s and for 30 years now, countries have become more and more dependent on imports to feed themselves. And when a state owes its political stability to rice or bread prices that are relatively affordable for the whole population and has to import all its rice or wheat, which is the case for many West African countries, for example, you can understand governments being a little jumpy about these situations.
In 2011, on the New York stock market, oil prices reached new heights that threatened the fragile economic recovery. Barack Obama put his foot down and named the guilty parties.
We can't afford a situation where speculators artificially manipulate markets by buying up oil, creating the perception of a shortage, and driving prices higher, only to flip the oil for a quick profit. We can't afford a situation where some speculators can reap millions while millions of American families get the short end of the stick.
It's a cliche to say that we make oil more expensive. It's completely untrue. We just try to buy it as cheap as possible and get the best price we can for it. We try to optimize the income, if you like. We don't care if the absolute price is $100 a barrel, or $25 a barrel, or $80 a barrel. What matters to us is the volatility, the movement of prices.
So even as we're
what bothers Mr. Obama is that he has no control. He's faced with 5 or 6 trading companies based in Switzerland that are totally private and who do business with whomever they want.
Transfer to Metra and South Shore trains at Randolph and Wabash. This is an Orange Line train to Midway.
The CFTC, the American Market Authority, has regulatory measures for speculation, intended to limit the interventions of pure financiers. At the Chicago Board of Trade, regulatory measures are never very welcome.
For me, 2008 was a really, really good year. It all depends on your position. And so there's not a good market or a bad market. It's how are you responding to the market itself, not necessarily good or bad.